Okay. Yep. Yep. Come on. There we go. All right. Welcome back. So today, I know I mentioned in the last video that we were going to go over some short-term, intermediate term, and long-term highs and lows. But, I think we are going to save that a little bit for a little bit later on, just because right now I think, that's a little bit more advanced to what, I wanted to stick to content-wise. Obviously, if y'all want to see it and if y'all, do want to learn about it, I'll teach it. Um, but just for the basis of keeping everything pretty simple, I'd rather, move on to something that, is, more easily understood than that. Because like I said, that's one of the most confusing topics there is within all this. So MotherFunded Boot Camp, welcome back to another episode. I'll, label these days and stuff like that. But anyways, today we're going to be talking and introducing a term that I like to use as far as, gives us an edge. And, it helps us, determine, how we execute. And that word is confluences, or if you just want to do confluence. And, I label confluences and a confluence as, like I said, a market or a candlestick tool that allows you to basically determine how you are going to engage the marketplace. And so what I mean by that is that yes, you can know the direction and where things are going. Like let's say, price is down here. You know it's gonna go up here. Obviously, I mean, you could just buy it and just hope and pray. But that's what everybody does. That's, gamblers, the hodls, the hold on for dear lifers. And, that's not what we're doing here. We're trying to be very precise, very accurate with our entries. And so we can maximize our risk to reward ratio. Even though I do not think that, somebody should be focused on a risk to reward ratio, I do agree with the fact that, instead of just, trying to, play around willy-nilly here and, just, buy it and, we have the least amount of risk involved and, like I said, it's a 1-to-1 risk to reward ratio and we're only risking $10 and, we're on a daily chart and, we're planning on being a day trader, that just doesn't make sense. So, we have to get good at, going into these lower time frames, using our higher time frame confluences as well, but going into the lower time frames where we plan on executing and getting very, very precise with our entries. So with that, I want to introduce the first confluence within all this, and it's the easiest one to basically see within the charts itself. And maybe y'all have heard of this, and maybe y'all have not, but it's called a fair value gap. And, let's just do a rough drawing of a fair value gap, actually. So there's two types. There's obviously a bullish example of a fair value gap, and there's a bearish example of a fair value gap. So what I'm going to first do is I'm going to draw the bullish example. So I'm going to use the same colors that I use for my candles. And we're going to see how well I do with my drawing. Okay, so first candle, and then we have the... Actually, you know what? I want to do this. I want to start from the bottom. Start from the bottom because price flows from top to bottom. Okay, come on. Now we're experiencing technical difficulties. Oh, good. So there's your first candle. So it's a 3 candlestick pattern. Let me clarify that. 3 candlestick pattern. Okay, got that. Pretty simple. 1, 2, 3. Just like a swing high and a swing low, this is also a 3 candlestick pattern. The first candle, and here's another thing. I also forgot to mention this within the swing highs and swing lows. It does not matter what combination of candles it is. So it really doesn't matter, if it's, all bullish candles or obviously it can't be all bearish candles. So at least has to have, I would say it's probably more likely going to have two bullish or no, it could be, just one bullish candle. But it has to have a bullish candle. It's going to have a bullish fair value gap is going to have a bullish candle in there, but, it doesn't have to be all bullish candles is, my main point. So first candle in the candlestick pattern is going to be that. Second is you're going to have a bigger one in the middle. And then third, let's do the line first. And the third is going to be like that. And you know what I'm going to do? I'm actually going to do this. So we're going to make this one black because I want to show that it really doesn't matter. But anyways, so we can see here, and I kind of want to this a little bit like that. No, that's too close. Too close. There is such a thing as personal space, buddy. Come on. There we go. So, whoa, what the heck is going on? Why isn't this thing? Okay. I think that's okay. Anyway, so this is essentially what the candlestick pattern is going to look like for a bullish example. So we have one candle body with a wick, and then we have another candle body with a wick that is separated by a very large candle body, which means if you can see here right now, if we understand, what we were talking about, that price is basically, a combination of balancing and rebalancing, we can clearly see this is balanced because there was trading up and there was trading down. There are no gaps within this. I mean, there's a gap right there, but I'm talking about, within the flow of this candlestick pattern, there is no gaps and there is no gaps between this. Here, there is a gap from this low, from this wick right here, the low of this wick right there, to the high of this wick right here. There is a gap, which means there is an absence of trading or price action. And what type of price action? If this is a bullish fair value gap, then it is absent of downward price action, bearish price action. And so the reason why it's called a fair value gap is because price is going to want to be drawn back down into this area to provide fair value for, the traders within the market. And how we mark this fair value gap and so it's noticeable is we take another box, and I'm going to make it lighter, and I'm going to make it green, and we are going to lessen the shading so we can see it inside it. So this is how we mark the fair value gap. And, I'll kind of, make it a little bit perfect. Right there. So from this candle's high right there to this candle's low, this is what's considered a fair value gap. Now, is price always going to be drawn into these? No. As we can clearly see, there are fair value gaps that are left open. And there's different context on why certain. Okay, well, I guess what the heck just happened. Well, oh shoot, I forgot. I'm still logged into my. Whoops, I'm still logged into my trading account. Well, y'all aren't supposed to see that because I'm not supposed to be a licensed professional. Hold on. Mouse is giving me difficulties again. I think we got it though. So, in this three candlestick pattern, we have this gap right here, which is labeled as the fair value gap. Price, and think of it like this, just like with, swing highs and swing lows and relatively equal highs and relatively equal lows, this is going to be like a big giant magnet. And like I said, price is going to want to come, drive back down in here. And then, based on market context and, market structure, it's either going to have it fail or it's going to continue. What we want it to happen is we want it to, continue in the direction. And this can be an entry mechanism because if you don't enter down here and there is no other entry up here, then you can just wait for price to come back down in here, and that's where you execute on. So that is a bullish fair value gap example. I want to do a bearish one now. So it's the exact opposite. So we have candle one. We're gonna make it black. And then candle two is going to be like this. And candle three is going to be like this. Wait, am I tripping? No, I'm not. Okay. Sometimes I feel like I'm dyslexic if I don't. Yeah, okay. When I'm drawing, sometimes I feel like I'm dyslexic, so bear with me. And, just like the other example, we'll just do this because, like I said, it really doesn't matter if, there is one bullish candle within this pattern. But anyways, as we can see, from this candle's low to this candle's high, there is a gap. And just think of it, visually as, if you can see a gap between the wicks of, two candles with a huge body in between it, then you understand that this is a fair value gap. So just like the other example, we draw a box and we're going to make this one red for a bearish example. And we're going to lighten it so you can see all that good stuff. But just like in the other example with the bullish fair value gap, we can clearly see if price is, in a downtrend and we don't enter or we don't have an entry up here and we see a fair value gap get created and we never really want to chase price. We don't want to enter all the way down here, but we see there's a fair value gap that's been created. All we have to do is wait for price to draw back up into it. And I'll do the magnet example again. Come on, there we go. And, once price gets back up into here, and let's say, the next candle, actually I'll draw the next candle. Say the next candle draws up into here. Okay, let's just say, yeah, it's a bullish. Boom. We can enter. We can enter right off this candle because it's in this fair value gap. Now, question, RJ, does it always have, or, what if it comes all the way up here? Great, that's fine. That means it's a completely filled fair value gap. Does it have to, though? No. So when we are using these as entry mechanisms, the highest probability for you to get filled or for you to enter off of one of these is at the start of it. Now, but you're like, but I'm scared if it comes up all the way up here and my stop is like up here or up here. Now, here's the thing. That's the risk you're going to have to take. That is what trading is essentially is. It's taking a risk. Now, if you do use this as an entry mechanism, my understanding or my, kind of rule of thumb is that if you enter off here and if you're a beginner using these, your stop loss has to be above the start of the three candlestick pattern. So for a bearish example, your stop loss would be up here if you're shorting. If you're going long and you're using this fair value gap, your stop would have to be below this candle. Once you get good enough and you're comfortable on picking which fair value gap is the correct one, then you can kind of reduce your stop to just this candle. But for right now, just to play it safe, always put your stop at the start of the fair value gap. So that means right up here if it's bearish and down here if it's bullish. And like I said, it could fill this much, it could fill this much, it could fill all the way up here. Now it shouldn't. Now this is how you can tell if, a fair value gap isn't going to be or isn't as, effective as you might think it is if it closes above or below for a bearish example. I'll do a bearish example. So if it closes below for a bearish example, below the fair value gap. So if it closes below this, the high of this wick and above the low of this wick, then you kind of got a problem. Now, I'm not going to say, it may not go in your direction if you have proper stop loss placement, but typically, like we always say, these markets are very, very precise. So if you notice this, you got to kind of be on alert, and you can either make the decision to save your stop and just get out of the trade altogether. And like I said, you're not going to take a full stop out, or you can take the risk. And, if you decide that, if you're taking a trade, then you're going to see the thing through, then that's up to you. That's a decision that you have to make on your own. But that's it. That's basically, all you need to know about fair value gaps. It's a three candlestick pattern. You have the first candle and the third candle separated by a larger candle with separations between the low of the third candle's wick and the high of the first candle's wick, and the opposite for the bearish examples. So let's just do some examples. I want to do a smaller time frame though. Yeah, we got a lot. We got a lot in here. Here's a good one. Here's a good one. We can see, okay, we all can see this right here. So we have this one candle right here. We have this large candle right here, and then we have this small little candle right here. From this candle's wick, from the bottom of this candle's wick right there to this candle's high, you see we have a gap. And as we can tell, or as we can see, this is a valid fair value gap because price uses it to seek lower prices. You see how it works all the way up in here, and it doesn't come up to, or it doesn't close above here? That's how you know it's valid. Now look at this one on the opposite. So we have candlestick 1 right there, candlestick 2 right there, candlestick 3 right there. It didn't work, RJ. Well, you have to know the context of the market. It's not always going to, like, just because you see a fair value gap doesn't mean that it's going to be useful. And once you get a little bit more experienced, you're going to understand that opposing bias fair value gaps also play a role in your trades. So as we can see, price closed below it. So what does that mean? Uh-oh, we're in trouble. If we have a trade on right now and our stop's below there, oh no, we're already stopped out. So as we can see, that's a great example of, when they don't, follow through. Which, like I said, you have to understand the context of the market to be able to use these effectively. This is not a plug and play, type of industry. You have to use logic, and you have to use your all of your knowledge of the markets. Here's another perfect example of a fair value gap. It doesn't actually look like it gets used though, but we can still mark it, and they're all over the place. Here's one right here with bullish. So 1, 2, 3 bullish fair value gap. This one gets used real well. Take a trade off that one. Boom. Here's another one right here. Here's a good example of one that closes above the fair value gap, but it still seeks lower prices. So this is what I'm saying, if you have proper stop loss placement and your stop loss is up here, you're not going to get knocked out. Will it scare the hell out of you? Probably. But that's a decision, like I said, you're gonna have to make. It's your, risk. It's, your decision. Like I said, it's your account. So at the end of the day, I mean, it's up to you. Let's see. There's a bunch of them in here. We can clearly see those, right? We got one right here, and then we got another right here. Come on, there we go. They don't get used, immediately. They do get hit right there and right there. And as you can see, you can see a nice reaction out of those. But what happens as soon as it closes below it? Yes, you still have a little bit, but I mean, and then it just gives up the ghost. So like I said, all we're doing right here is just, you know, learning how to identify them. We're not learning how, or we're not taking trades off of them. We're not full porting our accounts on them. We're just going into our charts and we are getting our eyes adjusted to identifying these within the markets. I'm not marking all of them. I'm just marking the obvious ones because, like I said, there's going to be a lot of them. And some are more important than others. And that is, like I said, what's going to come with, market experience and, combining the different tools and the knowledge that you have. Here's a good one right there. Boom. Nice. But yeah, so what I'm doing here right now is essentially what I want everybody to, work on. Just go into your charts. And we're going to put this for homework. Okay. Identify 6 examples. No, let's do 12 examples of fair value gaps. And I'm going to abbreviate this just like I did breakup structure. It's going to be FVG, which means fair value gap. So I want you to do 6 bullish examples and 6 bearish examples. Okay? Not that hard. You can knock it out within 5 minutes, like I said, and it doesn't have to stop there. You don't have to stop at 6. Um, do as many as you feel comfortable until you can just see them jump right off the chart. Like there's one right there, there's one right there, there's one right there. There's a small one right there. There's another small one right there. So, like I said, just get good at, identifying them and, locating them on your chart because when you get good enough, you're not even going to have to mark them. You're just going to see them and, you'll be able to utilize them, that way. But other than that, we'll continue, our discussions on other confluences. The next one is going to be, I believe it's probably going to be I'm not sure if I decided whether I'm going to do volume imbalances or order blocks next. I think I might do volume imbalance because it's going to actually continue or it's going to add on to the fair value gap kind of lesson. So we'll talk about volume imbalances next time. And until then, be safe.